Welcome to the daily update, where I'll go over the action in the market for Friday, January 26th, and then we'll see how things look for Monday, January 29th. We had a slight down day. The market is looking a little bit tired right now, and we're still seeing some negative divergences that I've been trying to point out that now are becoming more pronounced. They're really not getting dealt with right now. Some are longer term, some are more shorter term. And like I said, I'll be sure to go through those. We're looking a little bit tired right now. We've been going up pretty strong. The market seemed to kind of take the economic reports that came out. They were seen as positive for the most part, but we really didn't shoot an awful lot higher. Now we're dealing with the 4,900 level for the S&P 500. So let's go back and talk about what happened. Right at the open, we did have a higher open, and prices climbed to R1 at 4,905. So we got above the 4,900 level, but we didn't stay there. Then as the day went on, we got down back to the unchanged level. We even fell below that. We did find support at the daily pivot at 48.87. Then prices bounced between the daily pivot and the unchanged level and closed slightly lower. We were down 0.07%. It does go in the books as a negative day, but it was virtually unchanged. And we were below average with volume. And we are positive. And we've been having a good run as we've been working our way through January. We are overextended to the upside. Really, nothing got worked off in that regard. But we're also showing these negative divergences that I'll go through. The reports that came out gave us some more indications about inflation and interest rates, and I'll go through those reports. We're also keeping an eye on the different geopolitical events that sometimes can have an impact on the market. Some comments that we can make: we did set a new all-time high for the Dow. We did not for the S&P since we had a down day. We're still dealing with this resistance at 4,900. The mega caps did underperform. That's why we saw the indexes anyway languish. The broader market actually did a little bit better. And when you look at things, the advanced decline lines and so forth, we actually showed some improvement there. But because the mega caps weren't really performing all that well, they didn't help to drive the indexes higher. Discretionary continues to be under pressure. This is one of the negative divergences that we're keeping an eye on. This is one that I was mentioning in the daily videos, and now it just seems to keep going on. We're seeing the summation indexes diverging, where they're going down and they're actually negative, as we've been close to all-time highs with the S&P 500 as well as the NYSE. And then here's our short-term chart. We have the Stochc RSI, the Williams percent R, the CCI 14 and 20, and our stochastics. The usual suspects when we've been going up with any amount of strength. We also have our standard deviations chart and the RSI based on 9 periods. Looking at the intermediate term list, it's still pretty long too. We really haven't worked off anything here other than the percent B indicator. We came down back inside of the upper Bollinger Band. But we still have the CMB composite, the rate of change going back 50 periods. Some of our oscillators are starting to look extreme again, even though they are improving. The Sean trend meter, the RSI based on 14 periods, the bullish percent indexes, both for the S&P and the NASDAQ 100, the boom indicator, and I forgot to put this on the list for Friday's video. It's not extreme in the short term, but it is extreme in the intermediate term, and then our longer term new high, new low study for the S&P. Long term, we're still dealing with our 150 and 200 period moving averages being extreme positive. Here is the current scenario that really hasn't changed now, that the Fed might be done raising rates or possibly even cut rates. It's going back and forth now. We're coming up to a meeting that we're going to have in the upcoming week, and the market is not anticipating any changes there. They're looking ahead to March. And that's part of the debate right now. If they don't end up doing anything with rates, specifically cutting them, then they're looking further out down the line. And I'll have some charts to show you of this in the weekly video update. But we want to keep an eye on the economic reports, because the Fed has stated that if these reports come in stronger than expected continually, we might even see the Fed come in and raise rates. The dollar was up and interest rates were also down. We actually climbed up a little bit here with the 10-year yield being at 4.16%. So I forgot to change this line. The dollar actually ended up being down, I believe, and interest rates were up. The 10 to the 2 and the 10 to the 3-month yield curves, they're still inverted, but they've been inverted now for a year and a half to 2 years. Sentiment is still extreme positive. It didn't change, but we're above that 75 level where we're coming in at 77. Our trend is positive. The green line is on top. The ADX is going above the moving averages, both in the short and intermediate term. So we do have a strengthening trend. Even though we had the slight down day, I'm still keeping our bias as positive because it was virtually unchanged. And the last number of days, we tend to be positive as well. So that's why I'm keeping the momentum at positive. Some economic reports that came out, we had personal income. It came up 0.3%. That was as expected. Last time it came in up 0.4%. Personal spending really shot up, and this could have freaked out the market, but the rest of the report tended to be more friendly. It came in up 0.7%. They had expected to come in up 0.4%. Last time it was at up 0.4%. This is what the market kind of lagged here. The price index, it was up 0.2%. On a year-over-year basis, that comes in at 2.6%. If you remember, the Fed is trying to get back down to this overall 2% range, and this is helping that a little bit. This is also helping with the core PCE price index when you take out food and energy. Of course, the things you really have to have. It came in at 2.9%. Last time it was at 3.2%. So this was more market and inflation friendly. Pending home sales really shot up. They were up 8.3%. They had expected them to be up 2.3%. Last time they were up 0.3%. So we're seeing some real improvement there. Here are some charts. We have personal income and spending. The blue line is spending, where that's going up, and we're seeing just a little bit of an increase in the yellow line, which is income. This is the year-over-year core inflation. That's continuing to decline, and that's what the market likes. You can have an increase in spending and an increase in income as long as it's not increasing inflation. Right now, the market is very friendly to that. Here's the month-over-month spending where it did increase. So it's showing that the economy is still strong, but inflation is going down according to this report. Here are the pending home sales. We're finally getting back to being positive after they've been clawing their way back and showing some improvement. We're actually getting to a year-over-year rating that's in the plus category. Here's one chart to show you. This is the short interest for the S&P. Actually, it's short interest for the Magnificent Seven, the big mega caps. And there are two ways to look at this. When this is going up, that means that there's a lot of folks that are shorting these particular stocks. Okay, that can be negative in and of itself, because it takes a lot more guts to short things, especially straight in the market without using futures contracts or options. This can be very risky because your losses are virtually unlimited if the market goes against you. You can also take this as positive, because as this is going up, these folks, they sell to get in. And in order to close out these positions, they have to buy to get out. And that produces a series of built-in buyers on the sidelines that if prices keep going up, they have to buy to get out. And that's what we have when we call it a short cover rally. When price just seems to keep going up and up and up, and it's like out of control. It's like, man, how come this just keep shooting higher and higher? A lot of times that's the short folks who are getting out of their positions because they have to. There's a lot more stringent requirements when you actually short either stocks or indexes. Here's the intraday chart where we did have a higher open. We made it up to R1. That set the high for the day. And then we chopped sideways after pulling back. Then we saw a little bit of selling come in, took us actually negative down, and we established some support along the daily pivot. We bounced back up to the unchanged level, not really able to go positive again, and then closed right in between the unchanged level and the daily pivot. Here's the intraday chart where we saw some strength in the pre-market session. Then things gyrated around after the PCE report came out. We saw the move up and then coming back down, and we drifted just a little bit lower as the futures markets closed for the weekend. We did see where growth is starting to underperform value a little bit. The red line is now crossing back above the blue line. That's something that we want to keep an eye on. Lately, we've been seeing the blue line above the red line. If this continues, that could be another potential negative divergence that could develop. We also came down a little bit with our growth to value ratio for the S&P, where it had been showing a lot of improvement. It's starting to level off. If this continues to decline, that would be another sign of some weakness. Here's our end of day charts where growth was down, whereas value was up. When we look at the large caps, they were both up for the mid caps, but up less. And they were also up, but up a little bit less for the small caps. So across the board, value ended up outperforming growth. And to show you the small cap growth versus value, we had come up to the higher end of this range, and now we're starting to come back down more into the middle part of this range. We're also declining a little bit with the mid cap growth to value ratio, where it had been breaking out. Now it's starting to pull back. Just something to be aware of. We did come down a little bit with our S&P growth to value ratio on the end of day chart, where we had been showing some improvement. The longer we stay above these moving averages, the more we might see a golden cross with this ratio, but it's going to take a while for that to play out. This is another negative divergence that we've been keeping an eye on. We were up slightly with discretionary. When we look at the equal weight ETF, we were also up a bit with the staples, but we've been chopping more or less sideways. We're looking at the bigger picture right here, where we're not coming back to this previous high with the ratio between discretionary and staples, where the S&P had been going up. It's negatively diverging when we look at this ratio. That's another concern. Keeping an eye on our trend, where we are showing a strengthening trend, we're moving above the moving average and the green line is on top, so we default to positive. Also going up in the short term with the green line on top, that is also positive. We're below average with volume, but lately we've been seeing a pickup in volume. Here is sentiment showing with the Ulcer Index that fear is still pretty much non-existent. We ticked up a little bit with the VIX on the line chart and the bar chart. We're coming back up into the moving averages now. The VIX of the VIX also picked up a little bit, showing that there's a bit of an increase in volatility. But both the VIX and the VIX of the VIX have been giving very low readings. The equity put call ratio turned down just a little bit on the daily chart, and we're ticking up just slightly. That was because of the huge spike that we saw before the economic reports came out. So we want to keep an eye on this. More or less, we still are continuing to decline. We want to see, is this going to resume going down? That would be positive. If it keeps going up, that could be more negative. We're also watching the skew index. We're getting up into the red area now, where the market is anticipating some kind of a big move. We're not really sure. Is it going to be to the upside or the downside? We'll look at other charts for that. But when we finally get up into this red area, spike, and then start to come down, that is typically accompanied by, or at least followed by, some kind of a big move, either up or down. The advanced decline line actually showed a bit of an increase, and we're coming back up to this previous high. We're still not quite up to this previous high when we look at volume. In our new high, new low study, we're still seeing more new highs than new lows, but they're dropping off. Our 5 period is kind of drifting sideways. We got pegged near the top, and now it's starting to decline a little bit. We're flattening out after we had been climbing with our 10 period moving average. We're still above zero with the advanced decline ratio, both in the short and intermediate term. And this is still encouraging here. We tick down just a little bit with accumulation distribution, but we're still above the advancing moving average. We also declined just a little bit with the Chaikin money flow. It would be more beneficial if this red line would turn and go back up. We want to keep an eye on that one. And we're declining again a little bit with the Chaikin oscillator, because we're seeing some smart money at least not show up. They're not necessarily selling, but they're not doing a lot of buying right now. So when we look at our advanced decline line studies, we did go up with the NYSE common stock. We're coming back to this previous high with the S&P. We advanced slightly with the mid caps as well as the small caps, but we still have a ways to go with the small caps to get back to this previous high set in 2023. Here's the daily chart where we're still hanging in there okay. We did have a down day, but we're not at the point of breaking any support or anything. On the bottom, you can see where we did drop to below average. Here's the decision point scorecard. Hasn't been any changes as of late, but we are still extreme in the short term. When we look at our Stoke RSI, the Williams percent R, the CCI 14, and the CCI 20. We're showing a little bit of a sideways move now with the 20-period exponential moving average. We're still advancing with the 50 and showing some improvement with the 200. So this, on a moving average basis, we're still holding up. We also decreased just a little bit with the force index, but we're still positive, and the midpoint is continuing to go up. That's still positive. We are still extreme positive in the short, intermediate, and long term with our stochastics charts. We're still up in the +3 channel with our standard deviations chart, so that's extreme positive. We're still looking okay with the balance of power. We're still positive with the go, no-go system. We're still looking good with our highest high value. The TTM squeeze continues to show some improvement. The CMB composite is still extreme positive, and we're continuing to advance with the ease of movement. We ticked back up a little bit with the Arun. That's positive. This is where we're seeing some more continual negative divergences. The S&P McClellan oscillator has dropped below zero, and it went extreme negative. The fact is that we've been going up more or less since we saw a little bit of weakness, but we haven't crossed back above zero. So what's happening is the longer term indicator, and just to give you a quick tutorial on this, when we're below zero, that means the summation index will go down. When we're above zero, that means the summation index will go up. And we continue to decline based on price, but that's the negative side. When we look at volume, we are starting to turn back up. Sometimes this is a leading indicator suggesting that volume is leading price and eventually it will turn higher. But we've also been fooled by this leading indicator as well. So we want to be aware of that. We are looking a little bit better with the NYSE summation index. We're actually crossing back above zero. So the broader market is showing a little bit of improvement, but we are taking our time starting to turn back up, just barely turning up with the summation index based on price, but we're still continuing to decline based on volume, another slight negative divergence. We turned down just a little bit with the Swenlin trading oscillator based on price and volume, but both are still above zero. We're starting to go back up with the PMO, but we're extreme positive. We're above this red line. We're showing a little bit of an improvement, but we're still declining based on price and volume with this. And this is also a bit of a negative divergence. We tick down just a little bit with the PMOs that are rising. We're continuing to show improvement with the buy signals, and we're still extreme positive with the PMOs that are above zero. We're still positive with the Elder's Impulse system when looking at the S&P. The parabolic SAR is still positive, and we're starting to get extreme in the short term with the slope oscillator. The MACD is showing some improvement, so the momentum is looking better. But when we look at all of our oscillators, getting extreme with the slope and the TSI, those are our short-term oscillators. But in the intermediate term, we're showing some improvement with the MACD, the PMO, and the PPO. We are showing some improvement and just starting to cross the moving averages with the TRIX and KST. These are our longer-term oscillators. We're still above all the plotted moving averages, though, in our moving average tree. We're just a little bit below 70 now with the bullish percent index. We have a slight update, and this could easily go extreme again. We're just kind of chopping more or less sideways the last few days. And we're pretty much sideways here with the NYSE bullish percent index. It is still positive since it's above 50 and not above 70, so it's not extreme. We turned down a little bit with the NASDAQ 100 bullish percent index. We're still above 70, so that is an extreme positive reading. The money flow is continuing to go up and just about ready to give us an extreme positive reading. We're going back up with the ultimate oscillator. The vortex is still positive with the green line advancing. We're still just barely extreme with the RSI 14 and the RSI 9. On balance volume, it declined because we had a down day, but it's still above an advancing moving average. We're going back up slightly with the 200-period moving averages, but we actually ticked down a little bit with the 50-period moving averages. The Copic curve continues to be positive. We're still extreme positive with the rate of change based on 50 periods. We came down, but we're still rather extreme with the Sean trend meter. We're not extreme when we measure how far away are we from the 20-period moving average, but we are still extreme when we look at the 50-period moving average. And we're still showing some improvement with the 200-period moving averages. Don't have any Fibonacci or line studies for right now. The trend, though, is still positive, with the Heiken Ashi looking positive, the Kegi chart is positive, the Renko chart is positive, and the three-line break chart. These are all showing an uptrend. Long term, we're still extreme positive with the 150 and 200 period simple moving average study. We did see a little bit more of an improvement with the equal weight. It's still been underperforming over the last week or so when you compare it to the S&P 500, but it actually held up a bit better. So our ratio came down slightly. After the mega caps had been outperforming, that's when this ratio goes up. When this goes down, that means the broad market is outperforming. This is another longer-term negative divergence that we've been watching. We're going back and setting highs with the Dow. We're not even back to this previous high with the transports. We did see a little bit of a tick up with the utilities, where the transports continue to underperform the Dow. The Dow did go back and set a new all-time closing high, and it's positive with the Elder's Impulse system when looking at the diamonds. We came down a little bit with the NASDAQ, but we're still above this pivot point here. So right now, short-term support is holding. We also came down slightly with the NASDAQ 100, and we're still above this previous pivot point. We've switched over to neutral for the QQQs when looking at the Elder's Impulse system. Momentum is still positive for the NASDAQ 100. And we're just kind of frustrated when it comes to the small caps. They were up slightly, but they still have a ways to go to get back to this previous high. So far, you could say that this support level is holding, but they continue to be positive with the Elder's Impulse system for the small caps. And we're coming right up to this resistance level. We've been having a really difficult time with the small caps closing above this. We can get above it, but then we end up closing down below it. We're above 50 with the RSI, with the Russell 2000 small caps. Momentum is improving, but it's still negative. And the mid caps have been chopping sideways pretty much for the last week, but they still remain positive with the Elder's Impulse system when looking at the mid caps. The FANG index did not set a new all-time high, but it's just barely off of that. The financial sector was up and is still continuing to show some improvement. The dollar ended up being down slightly. And then looking at the 10-year yield, we were up, where the 10-year based on price was down. And then our possible positive scenarios were coming down with the Qs to S&P, but we're still above the moving average. This is the other area that is causing us some concern. Discretionary, mainly Tesla, has really been underperforming, and that's dragging this whole ratio down. We did tick down when we look at large cap growth to large cap value, but we're still above the moving average. Looking at our large caps, mid caps, and small caps, we are coming down slightly, with the small caps coming back down to their moving average. We're still in positive, extreme positive territory with the 10-day average of the S&P 500 highs minus the lows, but we have been coming down slightly. We're still positive here, and this is better for the broad market, where we're above zero with the 5-period moving average of the highs minus lows when we look at the Amex, NASDAQ, and NYSE. So what's our outlook for Monday? We're wondering, is this January effect? I mean, January is almost over now. We're going to end in the upcoming week, and we're not really seeing any real solid performance from the small caps. And then if we're up over 2% for the S&P for the month of January. So as long as we stay above that, our trifecta will have a 1 to 2 score for the rest of the year, but we need to watch that play out. Our technicals are positive, and in some areas they're showing some improvement, but we are seeing some negative divergences. We're also seeing a lot of overbought conditions, which are continuing. We won't have any economic reports on Monday, and then we want to keep an eye on the different geopolitical events. Here's the upcoming calendar for the upcoming week, where we're going to get the FOMC rate decision on Wednesday. It is likely that they're not going to raise rates, so the market is going to be focused on what do they say in their statement, and then what is Jerome Powell going to say in his press conference. We're going to get productivity and unit labor costs on Thursday in the ISM manufacturing, and then we're going to get the big employment report in Friday's session. Seasonally, kind of across the board here, we're no longer going to be in any weeks during or after options expiration. But looking at January 29th, we're neutral to negative with the Dow. We're flat out negative with the S&P, and we're neutral to positive with the NASDAQ. Here's a new chart to kind of get rid of the one that was getting outdated. This says stocks don't like lame duck election years. That's not what we're going through right now. So this isn't one, but there's still some uncertainty whether the current president is going to, in fact, actually run for re-election. This is comparing the fourth year when the president is ending their first term and how things end up performing, where it tends to be positive. We're following the orange line. We will be on the 19th trading day of the month, where we do see some negativity here during an election year for the S&P 500. Also, we are still in that choppy phase when we take all election years together. We also see sideways action, and then as we get a little further on, we see some weakness before we see strength, according to the Stock Traders Almanac. Then when the sitting president is running for re-election, we have been getting closer to mirroring what has happened seasonally there. Monday session tends to be the most positive day of the week, at least according to what happened in 2023. So we're not going with the down scenario yet. We are positive with our technicals, but we are overbought, and we want to keep an eye on those negative divergences. We would default to the positive side because we are showing that our charts are positive, but be aware that we are overbought and there are some negative divergences. We're not going with the sideways or neutral strategies right now, or because our trend is getting stronger both in the short and intermediate term. The warning signs, the risk on posture, it's just chopping all around, so I haven't really been showing that. We're still seeing that longer term negative divergence between the transports and the Dow, and that also follows through into the S&P. This is what I'm putting here. The McClellan oscillators and summation indexes are diverging. We're seeing it more of a divergence based on price when we look at the S&P. We're seeing a divergence based on volume when we look at the NYSE. Positive signs, growth, didn't really have a good day on Friday, but overall it has been improving. The equity put call ratio did tick up, but overall it has been declining. Our oscillators are improving, but some are already starting to get extreme positive. The parabolic SAR and the vortex charts are both positive. The bullish percent index is positive, and it's extreme for the NASDAQ 100. It's very near to extreme for the S&P. The Copic curve is positive. The momentum for the NASDAQ 100 is positive. Small and mid-cap growth has been chopping sideways, and we're coming back more into the middle part of the sideways range that we've been in. The financial sector is still hanging in there looking positive. So our conclusion, we're still positive. We are showing signs of improvement, but we're overbought, and I didn't put it on here, but be aware of those negative divergences. That's what we're watching in the short term. We can say pretty much that same thing in the intermediate term. We're also overbought in the long term with our longer term moving averages. Thank you. I hope you found this helpful. I will be posting the other videos over the weekend, so I hope you have a fantastic weekend, and I will talk to you in the next video.